I meet a lot of people every week who want to be trading millionaires, and you're probably one of them. Let's look at two main mistakes they make. Let's just take a coin. Coin, you toss it, it can come up heads or tails, and there's 50-50 chance of it doing that. Now, let's assume what you decide to do is do 100 coin tosses. One of the things that most people don't realize, and this is similar to trading, is you should probably get about 50 heads, 50 tails. Okay? You might get a winning streak or a losing streak. Let's assume tails are a loss. You might, and try this experiment at home and write it down if you wish, you might get a losing streak of 5 tails in a row. By the way, if you get 5 heads in a row, it doesn't make you the world's greatest coin tosser and suddenly you start a business of being a professional coin tosser and raise money behind it. It's a streak. It's not the probabilities. That's confusion number one. Confusion number two, like I said, is the significance of a losing streak. That wasn't because you suddenly turned rubbish. It was a random coin, remember, after all. But what are the significance of that? Well, this is why in the hedge fund industry, we always bang on about drawdowns. And when we were raising capital for my fund in the Middle East or wherever else in the world, we would always be asked, of course, well, two things, Sortino and drawdowns, and time to recover from drawdowns. What is a drawdown? Well, if you lose 5% of your capital, let's say you had 5 losing trades in a row, you know, that improbable streak, which is likely to happen, then you need 5.3% with the remaining capital to recover. Here's where it gets tricky. If you're down 10%, you need 11.1%. Not too bad, manageable. If you're down 15%, you need, of course, 17.6%. Now it's getting harder. You could lose a whole year. 5 losing trades, you could be down 15%. You need 17.6% to return. Now you're getting into sort of Warren Buffett territory. Let's say you're down 20%. You're going to start losing clients and capital at this stage. And you're going to need 25%. That might take you 1.5 years at least in order to recover. Lose 25%, you need a 33% return. That's 2 years of your life gone. Have a drawdown of 30%. Yeah, now it's starting to get really scary. 40%? Worrying. Why do I show this? The average retail client will happily all year long end up having 40 to 50% drawdowns, even 75% drawdowns. How the hell are they doing that? What is wrong with them? And then they need a 300% return in order to recover their original capital. What is wrong with them? Well, all they had was 5 losing trades in a streak. That was all. If you can't understand that, you can't manage it, you're going to blow up yourself. You're not going to make money and make those millions in trading that you wanted. But forget a career as a professional hedge fund manager at all. Thank you.